Hey, what's up, guys? I threw together a quick video just covering the DSCR programs that are out there. If you're in the real estate investment space, you definitely want to and need to know about these type of loan programs because they are a tremendous value when you're talking about doing like a burst strategy or you have some type of long-term hold, especially if you're self-employed, because there's qualification situations that DSCR loans can get you around. So I try to make the video as short as possible. I think it's about 15 minutes, but it's definitely worth watching because these are programs that you need to know about in the real estate investing space. If you have any questions, if you're watching this on YouTube, go ahead and throw those comments or questions in the comment section. I will answer those as quick as possible. If this is on like a Facebook group or something, you can always send me a DM and I'll do my best to answer you there as well. So anyways, I'll get into it. Here's the video. I hope you guys enjoy. A couple things I want to talk about real quick. Just a quick disclaimer. The first thing is I am not offering loans to anybody. This is not I'm not offering credit to anybody. This is all of the numbers that I go over are completely hypothetical. These are not real world scenarios. They're just numbers so you can get an idea of how these programs work. The other thing you should know is that these programs are always changing, meaning what's available today might not be available tomorrow, and the numbers that are available today might change tomorrow for the better or worse, okay? And every lender is going to be different in terms of what they are offering for these types of programs, okay? Meaning their rules around some of the numbers that I go over might change a little bit. So DSCR qualifications, they're based on credit and cash flow. So they're not going to take a look at your pay stubs. They don't want W-2s. They don't want tax returns. They don't want any of that stuff. They just want to know what is your credit score and does the property cash flow? And the big question is, does it cash flow at a 1-to-1 ratio? So let me explain what that means, okay? A 1-to-1 ratio is going to basically mean all of the expenses from the property compared to the income that the property is producing. If that is a 1-to-1, meaning if you have a $2,000 expense, meaning principal, interest, taxes, insurance, maybe HOA or any other liability or monthly hit that is associated, not talking about like gas and electric and those types of things, but some people have like metal roofs and these types of things. Though that expense compared to what it's going to generate for income. So if we have a $2,000 in expenses and $2,000 in income, I mean, you can rent it for that amount, you have a 1-to-1 ratio, okay? And so the big question always is going to be, how do they get this income number, right? Because the expenses are going to be pretty cut and dry. It's going to be the amount you're borrowing with the against the interest rate and the taxes and the insurance and these other hard costs. That's not going to change. Finding the expense is really easy, of course, because obviously the higher you go in the loan amount, the bigger that expense is going to be, okay? But the income is going to be a little bit more difficult, and they look at it a couple different ways. The first they're going to do, let me just back up a tiny bit. All of these type of programs, they're going to require an appraisal. So, you can have an appraiser come in. You cannot use these programs for a flip. So if the property doesn't have flooring, if it has bathrooms that, are maybe, torn up, a kitchen that's not there or whatever, exposed electrical, these types of things are unpainted or unfinished siding, these types of things. If it won't pass an appraisal inspection, the inspection portion of an appraisal, then it's not going to qualify, okay? So you do need to have a property that is in like good condition that somebody can live in the property. So when they do the appraisal, they're going to do what's called a 1007. That's a rent schedule. It basically is like an appraisal. The appraiser comes in and says, these are properties are renting, or this is what they would rent for. So based on those properties, I think this property will rent for this amount, and that is going to give you your income amount on the property. The other thing, and that's really good if there's no tenants, okay? So if there's no tenants in there, we need to get this number somehow, some way. You can also use DSCR programs for Airbnb. So if you're buying Airbnbs, you can use or if you're going to use it as an Airbnb, you can use the Dscr for qualification. It's a little bit more complicated in terms of calculating the income, but you can use these programs for Airbnb properties. If there are tenants in the property, then you can use like a lease and show 6 months of continuance, meaning this lease is good for the next 6 months, 12 months, 18 months. And you need to document 2 payments. And then we'll have to show bank statements showing that those payments have gone in. This is not always the same. Some lenders will just want to see 1 payment. Some will want to just see a deposit against the lease. So it's going to change, but just know that you can use a lease. There will be likely some sort of payment, like you're going to have to show some sort of payment that's been made towards that lease agreement in order for it to stick. Now, if it's not a 1-to-1 ratio, so let's say that you've got $2,000 in expenses, but the income is only $1,800, you can still do this program. The banks are going to have different ratio schedules, meaning if it's like 1 to 1.25, maybe you can go up to maybe you can go from a 1.1 to a 1.25 on the back end, meaning your income is less than your expenses. But they're going to require either some reserves, they're going to require some reserves almost all the time. And that's going to be really dependent on the loan amount and the credit score and also the LTV. Okay, so they're going to look at all these things. And if the property is not cash flowing, they might say, look, you cannot go up, you can't take out this amount of money because the loan to value is too high based on this property not cash flowing. Okay, so there's going to be some guidelines around that. So it starts to get a little gray. It's one of those things where it's like not every situation is the same, and there's 1,000 different scenarios that I can explain to you. Here is the real benefit of these types of programs in terms of the refinances. And so when you're doing a burst strategy, you buy a property and you rehab it and you want to refinance and pull the cash out, pay off the investors, and then put a renter in there. These are great programs for that, but there are also some things that you have to be aware of. So the first thing is that you need to make sure that you're at a max LTV of 75%. Okay, and again, this is based on a credit score. So 680 is going to allow you up to 75%. If you are at 660, you might only be able to go up to 70% or 65%. As your score drops, they are going to limit the amount of money you can withdraw based on those different scenarios. So let's go through a quick scenario. So if let's just say you buy a property, $100,000 purchase, it's got $50,000 entry and rehab. So let's just, in a totally hypothetical scenario, say you're into the property for $150,000, but the ARV is $200,000. Well, if you have an ARV of $200,000, you can just multiply that by 0.75, and it's going to give you a max loan amount on that property of $150,000, which happens to be the exact same amount. So look at that you're into the property for. Okay, so you can basically then do the refinance and pull $150,000 to consolidate and pay out the investor. So you might do a hard money loan to buy the property and then bring in some private money to backfill the down payment requirements and the rehab costs. This is how you would consolidate those. So it's important that you have enough margin in the property when you go to sell. You have to have at least 25% of equity if you want to use this type of loan to pay out your investors, okay? And there's some other guidelines around that I'm going to go into in a second. But in this scenario, you'd have $50,000 sitting in equity in the property, and then you would just put a renter in there, and you're good to go. So this is where there is a ton of benefit to these types of programs. Now, if you're going to use the Dscr program for a purchase, they're going to use the sale price as the baseline for the down payment, not the ARV. So you might say, well, this property is worth $125,000, but I'm only paying $100,000 because that's the sale price. It doesn't matter that what it's worth. It matters what you buy it for. That is going to be the number that they use in order to establish a down payment amount. Meaning, if it's $125,000 purchase price, you're going to have to put down 20 or 15% of the 125. And if it's $100,000 purchase price, even if it's worth 125, you still have to put down 15% of the 100,000. You might say, well, there's already equity built in there, right? I bought it for 100, but it's worth 125. It doesn't matter. They use the purchase price as as the number that they go off for the loan. So let me give you a quick example if you wanted to buy a property using one of these. Now, again, this is not for a property that needs any rehab. The property it has to have the flooring down. It needs to have painted sides, the roof needs to be in good shape, it's got to pass an appraisal, the inspection portion of an appraisal. An appraisal is not really an inspection, but there are guidelines that the property needs to fall within in order for the bank to lend on them, okay? So an example would be a $100,000 purchase price. The max loan amount would be $85,000. You'll need $15,000 down, plus you'll need to come in with the closing costs, okay? So again, the max LTV is 85%. Once you get over the 80% mark, actually once you get over like the 65% mark, but once you're over the 80% mark, you are taking massive hits. What I mean is the interest rates over 80% are going to be brutal. You're going to get just absolutely smoked. They're going to be terrible. But at the end of the day, even if the rate sucks, if the property cash flows, it might be the only way into the property. So I would rather have a property with a lousy interest rate that at least that still cash flows versus, a property, I can't buy the property, right? So again, anytime you're thinking about lending and loans, anytime we talk about credit scores, loan to value, these types of things, whenever there's more risk, it's going to be I like to say a more expensive rate, because when we talk about rates, every interest rate has either an associated cost or credit with them, okay? So the rates are always in existence. A 5% loan is always there. The question is always, how much is that loan or is that rate, okay? So I'm going to go over just some kind of quick things, a quick overview of DSCR loans. You don't need to worry about work history or income. Okay, again, this is not a DTI situation. They're not going to look at your credit cards and all that stuff. They don't care. They do care about your credit score, but they don't care about your money coming in versus your money out. This is great for entrepreneurs because a lot of times when you are self-employed, you write everything off on taxes. Everything is written off, okay? So on paper, you are just poor. You look like you can't afford anything, but that's because you're taking advantage of the tax system and you're writing everything off. But it creates a problem when you're trying to buy a house. So this particular program, again, for investors is awesome, especially if you're a full-time investor and only self-employed. So you can close in the LLC. You have to have 12 months history of either managing rental properties or ownership in a primary residence. They want to make sure that you are that you've owned a property before, okay? And that can be somebody that you're JVing a deal with. As long as that person has some sort of interest in the property, they can kind of check that box. You can have unlimited properties. Why is that important? Because a lot of times if you're going to get a conventional loan on a property, you can only have 10 properties max. Fannie and Freddie will only allow you to have 10. So for investors, if they own more than 10 properties, they cannot buy another property with a conventional loan, FHA, VA, or whatever. So you need to be on title for 6 months prior to closing for cash out. Okay, so if you're using this type of program for the BRRRR strategy where you're buying a property, you're going to rehab it, and you're going to refinance out or refinance and pull cash, you can only do that. There's a 6-month seasoning period, so you have to be on title for 6 months. That's really stinking important because a lot of times people are like, oh, I need to pay off my hard money guy as quick as possible because I'm getting smoked by my interest rate and I'm just bleeding holding cost money, but you have to be on title for 6 months. So it's something to really take note of. You can use single family, 2 to 4 units, townhomes, condos, all those things. I do believe they have these programs now. I know they're over 8 units, but I can't remember. I can't remember exactly how high you can go using these DSCR programs. And I also think there are some DSCR programs for commercial properties. I'm just not familiar with them because I've never done them. There are prepayment penalties, generally speaking. Okay, so it's usually you can't refinance for 3 years. If you want to, okay, so just a little bit here. So there are prepayment penalties, and usually they're at 3 years. But when you close the loan or before you close the loan, you can ask for a 1-year prepayment penalty, a 2-year, or a 3-year. But as you start moving the prepayment penalty down, meaning I'm not going to be in this loan for very long, which means you're not going to get as much interest, what the lenders do is they start hiking the interest rate up. So the lower your prepayment penalty in terms of years, the higher the interest rate the property is going to have. And then usually when you do break these type of, like when you do have to prepay, if you're like, I got to sell the property, I have no choice, usually they'll hit you for 6 months interest if you paid early. So you sell the property, they're going to hit you for 6 months interest, generally speaking. Minimum loan amount $75,000. I do think that there are programs out there now that are that go lower, maximum $3 million. There's probably programs that are higher than that now too. Max cash out unlimited with some programs. Yeah, you can. That's I don't even know what I'm talking about there. Dscr qualification, just in terms of credit. So they're going to use your credit score and estimated cash flow. Talked about that. 680 will get you 80%, 80 to 85% LTV on a purchase, and 75% LTV on a cash out. You can go as low as 600. However, there's going to be loan limit requirements, meaning there's just going to be all kinds of, again, as your credit score comes down, everything gets tight. No, we're not going to lend you 600,000. We're only going to lend you 400,000. Or no, you can't go out up to 75% LTV because your credit score is only 600. You can only borrow 50% of the property or 45% of the property. So a lot of these things are, look, I got it right here. A 620 will give you the max LTV on a cash out at 60%. So again, there are seasoning requirements. One of those seasoning requirements, if you've had a bankruptcy or foreclosure, it's a 48-month seasoning. And then they're going to use the lower of the mid score of all the borrowers. That may or may not be true anymore, but generally speaking, they always use the mid score. It's just who of the borrowers who are on the loan, whose mid score they're going to use. And generally speaking, it's the lower mid score of all the borrowers. Fixed or interest only. So interest only, it's not adjustable. There are interest only, not adjustable programs. Generally speaking, interest only 10 years. Yeah, so there are programs out there where you can do an interest only program for 10 years, and then after 10 years, it will convert to a 20-year amortizing loan. The thing is most people who are doing these types of programs, they're looking for the lowest interest rate they possibly can get for, let's say, 5 years, 7 years, 10 years, because they want to they know they're going to refinance or sell the property. So they just want to make sure as an investor that the property cash flows. That's what they care about. Fixed will amortize over the full 30 years. Yeah, interest rate is fixed, so that's self-explanatory. That would be just like a regular 30-year fixed mortgage. Okay, cool. So that's kind of it. I kind of went over everything really quick. I know I'm talking fast, but I've seen a lot of people ask questions about this. I did this training probably a year ago, and I posted it in one of the groups. I wanted to do one again just real quick and get it out there for everybody to take a look at. If you have any questions, put them in the comment section.